August 1857. A lone telegraph alert flashes across Manhattan, exposing a massive $2 million rogue lending scandal. Within minutes, America's most prestigious bank completely collapses. That one single message sparked a high-speed panic across the wires that literally brought the entire global financial system to its knees.
Okay, let's dive into this. Because to understand how a single wire decimated the system, we have to look at the macro environment. America was absolutely drunk on speculative liquidity. You see, the California gold rush had flooded the domestic money supply with fresh specie, which drove credit costs right through the floor. Suddenly, Wall Street is hyper-accelerated. Railroads became the ultimate speculative play. They were essentially the tech stocks of the 19th century. Driven by all this cheap credit, the market absorbed an astonishing $600 million in fresh capital. Everyone, and I mean everyone, assumed this boom would just last forever.
So between 1850 and 1857, U.S. rail mileage absolutely triples. But here is the fatal flaw in all this. Wall Street had built a globally integrated machine with absolutely zero margin of safety. It was a completely deregulated expansion that relied entirely on rapid growth and endless liquidity. It was just a powder keg waiting for a spark.
Now, the primary fuel for this explosive growth was the Land Grant Act of 1850. The federal government handed millions of acres of public domain land to states, who then transferred it straight to private railroad corporations. These railroads took this sovereign, taxpayer-subsidized land and used it as direct collateral. They pledged it to bondholders to lure in massive waves of elite British capital from merchant banks. The mere promise of a rail line inflated Western land values, which then inflated the railroad's collateral, shooting stock prices straight to the moon.
But underneath the surface of this booming corporate equity market, a massive contradiction was brewing. In July 1854, the ultimate arbiter of Wall Street respectability, a guy literally dubbed America's first railroad king, had his attorney abruptly resigned, and he left with a chilling warning to the board of directors: "You will find there is much that is wrong." Well, it turned out the railroad king was secretly running one of the most devastating insider frauds in financial history.
Schuler wasn't just over-leveraging companies. The guy was actually printing fake equity. Because he had exclusive, unmonitored control over issuing stock certificates, he kept highly compartmentalized, falsified ledgers. To cover his own disastrous personal leverage in other ventures, he floated over 19,000 unauthorized shares. This drained roughly $2 million straight from retail investors before he fled the country. Overnight, the corporate equity market's credibility just evaporated. It proved that this opaque structure could wipe out early equity investors in the blink of an eye.
Just as corporate equities take that massive hit, the market gets slammed by a brutal macroeconomic shock right out of Washington. In March 1857, the Supreme Court hands down the Dred Scott decision. Financial markets reacted to this like a devastating economic earthquake. The ruling essentially allowed slavery into Western territories, which introduced immediate political instability. Fearing territorial violence, Northern families abruptly halted their westward migration. For Midwestern railroads, this meant frozen forward earnings projections. Their valuations relied entirely on families migrating, buying land, and generating freight revenue. Instantly, the railroad bubble popped.
And this brilliantly illustrates the real-world portfolio impact, which was violent. Midwestern rail investment plunged from 75% of the market down to just 25%. Capital aggressively fled the political chaos of the North and West and flooded directly into Southern state bonds and railroads. Because the ruling legally affirmed slave property, international investors actually viewed the Southern cotton economy as a legally secure safe haven. This, of course, heavily reinforced the dangerous Southern illusion that their economy was completely invincible.
So the market is incredibly fragile. It's over-leveraged, suffering from a demographic freeze, and dealing with massive capital flight. Then we hit August 24th, the breaking point. The New York branch of the highly conservative Ohio Life Insurance and Trust Company fails. Turns out, a rogue cashier funneled $2 million of the bank's capital into crashing rail stocks. The newly built electric telegraph flashes this news across the country in minutes. Terrified depositors run on the banks everywhere. To protect their physical gold, banks violently call in their outstanding loans to brokers. The result? A devastating, nationwide liquidity trap, forcing massive fire sale liquidations across all asset classes.
Now we're in a state of extreme systemic distress. East Coast banks are pinning their absolute survival on a massive shipment of gold arriving from California just to shore up their depleted reserves. But then, an unpredictable act of nature raises the stakes to a fatal level. On September 12, a Category 2 hurricane sinks the SS Central America.
30,000 pounds of Tier 1 commercial bailout gold, which is billions in today's money, goes straight to the bottom of the Atlantic Ocean. When that news hit the telegraph wires, the final remnants of market confidence completely shattered.
Faced with depositors demanding physical gold that literally no longer existed, banks across the East Coast were forced into defensive suspensions. They completely stopped redeeming paper notes for physical gold. To prevent the entire payment system from freezing up, Wall Street leaned on a brilliant technological fix they'd established just a few years prior, the New York Clearing House. Think about this. Before 1853, banks paid each other by sending porters walking down the street with heavy bags of gold. The clearinghouse replaced that chaos with centralized net clearing and species certificates, creating a framework of institutionalized stability just in the nick of time. To survive the panic, the clearinghouse introduced a profound financial innovation. They effectively pooled the collective reserves of all their member banks. If a bank needed to settle its daily balances but had no physical gold on hand, it could submit its portfolio of high-quality commercial loans as collateral. The clearinghouse applied a strict mathematical formula, basically placing a 25% discount rate or haircut on the collateral, and then issued joint loan certificates. These certificates were accepted at par to settle interbank balances. This completely bypassed the need for physical gold and successfully expanded the money supply just enough to stabilize the system.
So the crucial point is that this single crisis permanently rewired the American financial landscape. Capital pivoted aggressively away from speculative Western land and directly into heavy Northern manufacturing. Things like iron foundries and militarized rail networks, which laid the economic groundwork for total war in the 1860s. And because the traditional gold-backed banking system proved completely inadequate at handling massive systemic shocks, it forced the federal government toward a fiat currency revolution, paving the exact way for the greenback.
The Panic of 1857 proved that when technology connects global capital faster than regulation can secure it, a localized spark in a single bank will always trigger a global fire. It was the world's first real look at the double-edged sword of a hyper-connected marketplace. As we sit here today, trading at the speed of algorithms rather than telegraphs, is your portfolio truly insulated from our own digital contagion? Let me know in the comments where you think the next structural spark is hiding.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.